Good morning, and thank you for joining us for this live and very topical webinar on commercial and retail leases in light of the COVID-19 pandemic. My name is Adam Kutry and I'm a Senior Associate in the Commercial Disputes team at Bartier Perry. Today we will discuss commercial and retail leases, how they have been affected by COVID-19, the regulations recently issued in New South Wales, the financial information required to assist in negotiations between tenants and landlords, and what businesses will need to consider in order to re-establish the physical workplace and practical considerations businesses will likely face over the next 3 to 6 months. During today's webinar, you'll hear from Tristan Gannon, a Senior Director in Advisory and Transaction Services at CBRE, who is one of the most experienced tenant representatives in the Sydney market. He will then pass over to Melissa, who's a partner in the property planning and construction team at Bartier Perry with over 20 years of experience, acting for landlords and tenants in drafting and negotiating industrial, commercial and retail lease agreements. From Melissa, you'll hear from Patrick Flanagan, who's a partner at RSM Australia with over 30 years experience advising SME owners on acquisitions, structuring, raising capital and improving their financial performance. And finally, we'll hear from Nicole Fitzgerald, who's the Head of Workplace Strategy at CBRE, who's currently involved in the CBRE task force for reopening the world's workplaces following the COVID-19 pandemic. We at Bartier Perry are pleased to be able to co-present this seminar with CBRE and RSM Australia to provide everyone here today with information from each of the experts in their respective fields. Provided time permits, we will try and address any of your questions which you may have at the end of the webinar. If you do have any questions, please upload them using the chat function in the toolbar on the right-hand side of your page. And without further ado, we'll kick off today's session and I'll pass you over to Tristan, who will give a brief update on the state of the current market.
Well, good morning, everyone, and thank you for joining us. I wanted to start by sharing 3 observations that CBRE have made in response to the COVID-19 pandemic. Firstly being our predictions on the virus, secondly, the economy, and thirdly, the property markets. So to start with the predictions on the virus, most countries are still in phase 1 of the pandemic, being shelter in place. However, parts of Asia are now starting to move out of this phase and are cautiously reopening their economies. CBRE anticipates that the restrictive orders that are currently in place are likely to remain until around mid-May and then progressively ease as containment measures become more advanced. The rollout of mass testing and contract tracing does allow for a lot less intrusive virus control methods. And we're really starting to see that across Australia over the coming weeks. The image that you can see on screen outlines how the spread of the virus is being managed across APAC. And the countries shown in green are showing success in terms of flattening the curve. I believe that Hong Kong has had now 6 consecutive days without any infections, and that Hong Kong, Taiwan and mainland China will allow for international travel between those 3 countries from next week. So positive news. And as positive news on containment of the virus continues to emerge, we're seeing a lot of organisations now turn their attention to reopening their workplace and starting to consider how the workplace will operate in a post-COVID environment. And my colleague Nicole will touch on that later on in this session. The second outlook that I wanted to discuss was the economic outlook. So the graph on screen shows CBRE's house view on the impact on GDP throughout the pandemic. And so in Australia, which is the image on the right, we were forecasting pre-crisis GDP growth of just over 2%. However, we've now revised this down to be a fall of about just under 8%. So that's a fairly dramatic impact that we're anticipating the virus will have on Australia's GDP levels throughout 2020. However, whilst we are forecasting a very sharp economic recession in the first half of 2020, we do remain optimistic that stabilisation and growth will restart in Q3 and then really start to gain traction and accelerate through into Q4. We also still believe that 2021 will see a bounce back in GDP, and that's really been driven for the following 4 reasons. Firstly, this recession is being driven by limits. limits being placed on society's ability to spend, and also limits being placed on businesses' ability to trade. And if we compare that to previous recessions, which have really been due to an internal imbalance in the economy. So once these limits are removed, we're really anticipating that the economy will recover fairly quickly. Secondly, the economy was in relatively good shape before the crisis, with very low levels of government debt, which has enabled governments to move quite quickly. The third is the stimulus packages that most developed countries have deployed have been extremely large, with additional stimulus packages to come. And the collaboration between governments and central banks in terms of stimulus packages and liquidity packages has had quite a profound impact. And the fourth factor is we anticipate there's going to be a fairly powerful impact as a result of pent-up demand within the consumer sector. However, the biggest area of uncertainty in all of this is the impact of the unemployment rate. Unlike the GFC or the tech crash, and because of the speed at which governments have deployed stimulus packages, we're not anticipating that the unemployment rate will remain as high for as long as in previous pandemics or in previous recessions. However, it will remain elevated over the next 12 to 18 months. The third observation I wanted to touch on is how all this is impacting the commercial real estate markets. And property markets always lag behind the economy. So even if we see GDP growth displaying a V-shaped recovery, the property markets will probably have more of a U-shaped recovery. Historically, there's been a very high correlation between employment and vacancy rates in major cities. However, we think that this time it might be slightly different, largely due to unemployment not being as highly geared towards white-collar employment in this recession. It's mainly being felt in hospitality, retail, and tourism. So for the Sydney CBD, we're anticipating that face rents, or the rents before adjustment for incentive, will hold very close to the levels they were at pre-crisis. Incentives will increase from their current rate, or pre-crisis rate of about 20% to 30% by year end. And the vacancy rate in Sydney will increase from its pre-crisis level of about 3.3% up to about 7.5% by year end. And so we think this increase in vacancy is really being driven by lower population growth as a result of reduced immigration and also rising unemployment. So essentially, landlords will try to maintain their face rents, but over the course of the next few months, we're anticipating that incentives will increase. So they're really the three main observations that I wanted to cover on the economic and market impact of the virus. But before handing over, I just wanted to touch on, there are a lot of tenants at the moment who are dealing with offices that are either partially or completely empty, yet they're still being obligated to pay rent. And so we're working with a lot of those organisations on how to approach a discussion with their landlord around rent relief. And the code of conduct, which Melissa will elaborate on, has been really good in terms of providing some guidance and framework around that. However, the advice that we're giving to our clients is really in three forms. Firstly, be prepared to engage with your landlord in a positive and collaborative manner. Secondly, be forthcoming with information which demonstrates the extent to which the pandemic is resulting in financial hardship. And thirdly, be prepared to share the burden with the landlord. In a lot of instances, the landlords are also experiencing hardship. And so it really does need to be an equitable solution which works for both parties. So with that, I'll hand over to Melissa to elaborate a little bit more on the code of conduct.
Thank you, Tristan. So last Friday, regulations were enacted to give effect to the mandatory code of conduct. They were welcomed because it gives some certainty to some of the leasing principles under the code that were a bit grey. The regulations affect only certain leases, but it will provide a good framework for landlords and tenants renegotiating the terms of their leases. The leases affected by the regulations are retail shop leases, and bear in mind that because of the definition of retail shop lease in the Retail Leases Act, it will include licenses and oral agreements. And it includes leases of premises and land for commercial purposes. The regulations apply to leases that have been renewed pursuant to options for renewal, and also to leases where tenants are remaining in the premises under their holdover provisions. The regulations do not apply to any new leases being entered into on or after last Friday, the 24th of April. So for lessees entering into leases now, part of their negotiation should include contractually giving themselves the benefits and the protections under the regulations. We've just asked a landlord in a lease we're negotiating to agree to abide by the terms of the regulations. So the regulations apply to an impacted lessee. An impacted lessee is a lessee who qualifies for JobKeeper, and has turnover for the 2018-2019 financial year less than $50 million. Importantly, it notes that if the lessee is a corporation, which is a member of a group, the threshold of $50 million in turnover relates to the turnover of the group. The regulations don't give any indication as to how turnover is to be defined, and I'm looking forward to Pat shedding some light on this for us. It only says that it will include internet sales or services, which is different to how turnover is defined in the Retail Leases Act, where online sales are excluded unless they arise from the premises. So the regulations stop lessors taking action where a lessee does not pay rent, does not pay outgoings, or fails to keep the business open for hours specified in the lease during the 6-month period until 24 October. Lessors cannot terminate leases, seek to take possession of premises, require interest to be paid on unpaid rent, draw on any security bonds, or require guarantors to perform the obligations of lessees. Nor can they seek orders for damages or any other remedy available to it at law. The regulations also operate to put a freeze on rent review. No rent reviews are to be carried out during the 6-month period. One area where the regulations have given some welcome guidance is in relation to how outgoings are to be treated during this period. If a landlord gets a discount or deduction on its land tax, statutory outgoings such as council rates or insurance, the extent of that reduction must be passed on to its lessee. And then under the leasing principles of the code, lessors may discount or lessen office services and pass that reduction onto their lessees as well. We say, and we're recommending lessors continue to invoice lessees for outgoings, even if they are not being paid during this 6-month period, because that will provide evidence of the outgoings that should have been payable and will help any repayment plan after the 6-month period, the prescribed period, has expired. The regulations put an obligation on the parties to renegotiate the terms of their lease if one of the parties wants to do so. Regard has to be had to the economic impacts of the COVID-19 pandemic, and also to the leasing principles set out in the code. Now, even if your lease doesn't fall within the regulations, as I say, this is still a good framework within which to conduct your negotiations. So the code's looking for lessors to ease the pain of lessees by offering rent reductions based on the turnover, the lessening of turnover of lessees, up to 100% of what would have otherwise ordinarily been payable. 50% of that is to be a rent abatement and 50% a rent deferral. How these agreements are being documented will become increasingly important, especially as we get out of the prescribed 6-month period and the parties look to enforce the terms of the lease and to give effect to their renegotiations. Some lessors are setting out the terms of the renegotiation by way of letter, and that could be fine if it is just a simple rent abatement. However, if rent and outgoings are being deferred and the lessee is going to repay these over the remainder of the term of the lease, or the minimum prescribed period under the code of 24 months, it will become important to have the agreement reduced in writing and enforceable, particularly if your lease expires before the 24-month repayment period expires. A deed is also a good way to set out representations that may be made by lessees in convincing or having the lessor agree to the renegotiation of terms. Lessees need to be transparent. They need to open their books so that lessors can see the downturn in their business, and so that an equitable agreement can be reached between the parties as to how the lease terms are to be varied. It is a sharing of the pain, after all. So open your books, be open and honest. We are hearing stories where lessors are concerned that tenants are not presenting enough information and they query the extent of the downturn in their business. If this is a concern for a lessor, warranties and representations could be put into a deed so that if a lessee does prove later on not to have been completely honest, there will be remedies for the lessor. Maybe consider clawback provisions if what's being represented at the time of entry into the deed isn't correct. Bear in mind that although the regulations do prescribe matters to be negotiated and taken into account, parties are free to negotiate whatever they want in relation to the lease. One of the areas that is proving difficult at the moment is how do lessors understand the financial impact of the tenant's business, and I'm really looking forward, Pat, for you to assist us to work this out. And so with that, I will hand over to you.
Thanks, Melissa. Okay. So Melissa's articulated one of the key issues with the mandatory code of conduct is the reference in the legislation as it's enshrined at a local level and the code itself. And the code makes and draws heavy reference to the JobKeeper Scheme in determining what businesses would be eligible and certainly what needs to be considered in looking at revenue degradation. I've got a bunch of slides there that are pretty detailed, and they're more for people who are listening to take away. So what I want to do is just summarise the key principles to think about in assessing revenue, because it's not a straightforward exercise by any measure. The first thing to think about is a business eligible? And the JobKeeper Scheme talks about whether a business is eligible for same, and that includes that the business be registered, i.e. hold an ABN on the 12th of March. So that's the first thing to think about. Then there's the selection of the relevant turnover periods, and these are actually quite involved. There's 9 different turnover tests that can be examined depending on whether you're a monthly BAS lodger or a quarterly BAS lodger, and indeed there's a measure of forecasting involved for businesses that may not have been affected in the month of April when the JobKeeper scheme took effect. Some businesses we're seeing obviously aren't being affected until later on, depending on their revenue and billing cycles. So those factors need to be considered. So if a business does satisfy the JobKeeper test, the code talks about the scheme principles and actually talks about the fact that a business, if it's eligible for JobKeeper, would automatically qualify under the Code of Conduct. Now, reading the Code of Conduct, there's an anomaly there, and this is probably more a legal question for you, Melissa, but the Code of Conduct in the definitions talks about the fact that there's been a revenue fall off or a degradation directly due to COVID, whereas the JobKeeper scheme is somewhat wider in terms of its capture net and actually makes reference to the fact that you don't have to have a diminution in revenue just as a result of COVID. So there's somewhat of an anomaly there, which I'm sure will be sorted out through people testing the legislation in due course. In thinking about what are the factors that are going to influence whether somebody qualifies by way of threshold or not. Melissa mentioned you must be an SME business and you must have a turnover less than 50 mil. Now, as Melissa also mentioned, a lot of businesses are part of bigger groups. So the JobKeeper scheme firstly talks about understanding whether businesses are in or out, and that includes consideration of what are called controlled entities and affiliated entities. So they're technical tests basically about whether you would consolidate a business as part of a larger group. So they're the sort of questions that you'd need to be considering if you're a tenant and indeed if you're a landlord as to whether you're in or out of the JobKeeper scheme. Then there's the practical issues of trying to understand how revenue has been impaired. And there's a whole bunch of things to think about, including what are the transactions within a group, for example. So they need to be eliminated. You need to think about exchange rates if people are buying and selling from overseas, because they're going to influence transactions. Any related party transactions need to be eliminated because effectively, from an accounting perspective, they're net nil. There's also other factors. The JobKeeper test excludes revenue not connected with Australia, so that's interesting for businesses and will be a factor for those that are exporting services overseas. The legislation also tries to deal, this is the JobKeeper legislation, with the complexity around businesses that change shape. And changing shape can happen for a whole raft of reasons, people buying and selling business units or divisions. There could be private and capital transactions involved, which need to be adjusted for. So the legislation attempts to deal with all of those issues. There's also a lot of businesses that don't have obviously uniform revenue cycles, so that creates further complexity. And the Commissioner of Taxation, who's charged with effectively administering the JobKeeper code, has the discretion to look at businesses that might have been started more recently, particularly say an IT business that might have only been up for 6 months. So it's very difficult to get comparison of related periods or relatable periods. So the Commission's got discretion to deal with businesses that might be startups Also businesses that might be cyclical or have a seasonal trading pattern as to whether they're in or out of the scheme, or businesses that might have had major structural change, i.e. they might have divested a unit or not. So the upshot of all of that is assessing revenue changes is not a simple exercise. Clearly, if a tenant's looking for relief, they need to think about whether they're entitled to the scheme automatically, even if they're not a participant of the JobKeeper Scheme automatically. Obviously, there's the code of conduct principles still need to be considered in their application. So that's there's a bit to think about there, and certainly a lot and more than I could cover in a short time here. But I'd certainly encourage people who are having to address applications to take some advice where it's needed. And then the final comment out of this is that the evidence process to assess what's reasonable. The Commissioner has some guidelines in terms of what reasonable evidence looks like, and it is around the balance of probabilities. I am aware already that there's discussion in terms of what genuine hardship means. So there's going to be debate about that. And then the final aspect to this, which is interesting insofar as the code of conduct it refers to, and Melissa, this again would be more of a legal question, is it talks about the application of the code beyond the JobKeeper period, if you like, which is 6 months through to end of September, but also makes reference to subsequent recovery periods in terms of its impact on leasing arrangements and rent abatement. So that's an area that will no doubt be up for further debate. All right, thank you very much for listening. I'm happy to take any questions later, and I'll hand over to Nicole from CBRE.
I did the mute trick. So thank you very much for that. Hello, everybody. My name's Nicole Fitzgerald, and I head up CBRE's Workplace Strategy and Change Management team here in the Pacific. So we're going to change tack a little bit and have a conversation about what's going to be happening in the workplaces in the future. What does all this mean? But of course, what are the really practical things that you need to be planning for now, as we are hearing that we're getting closer and closer to being able to roll some people back into the office in a very staged and considered way. Now, we do have the chat function there. I get lots of different types of questions. So please feel free to pop a question in that chat window, and I'll keep an eye on that as we go through this. And I'm very happy to take any questions in this session or, of course, afterwards. Now, importantly, before we get into the right here and now, it's important to think about there's some of the silver lining that we're getting out of obviously a very challenging situation that is influencing what our workplaces are going to be like in the future. So we are all rapidly developing new skills that are going to give us greater resilience in the future. So we do need some more practice. It's only been 4 or 5 weeks. But leaders are getting far more effective at leading high-performing virtual teams. We're getting past just being able to use VC and webcams on and mute off, but we're actually getting to be more productive. We're solving problems, we're creating new ideas, but importantly, we're embedding technology into our day-to-day norms of our team. And this is fundamentally going to change how we all operate together and work together in the future. And the best place to look is at some of those organisations that were already really good at those skills that I just mentioned. So those people, like the Googles or the Ciscos, the like, the workplace plays an incredibly important role in their team, in their culture and performance of the business. It's just different. The purpose has changed. So certainly the workplace isn't dead. It's just got a slightly different role. It's pivoting. So that is really about when people coming in, they have that opportunity to bring people together face to face, because we still know that has the highest influence and connectivity about relationships. So that's still something that's going to be fundamentally important, of course, for that social and mental health. that bump factor, we just can't quite get sorted on the virtual channels. But importantly, that working from home is not quite for everybody. We have tools, resources, experiences that we can only get in the workplace that are going to still draw people in and be the destination, a preferred place to be. So a big focus is around, in the future, having a think about the portions of our space and how we change them, and a lot more of that being handed over to that connection and collaboration. Now, of course, there's a lot of questions about density and what that means in the future, as well as occupancy. We saw a big push in the last 2 years to lower the density. We've seen buildings go from a standard of 1 to 10 square metres per person, now dropping new builds to 1 to 8 square metres per person, that were very attractive to people, to occupiers, as they looked and seek new locations. We are expecting that to ease off a bit because of just being more cognizant and aware of what putting people so close together can potentially mean. But we do also see that occupancy rates are definitely going to drop. So from the research that we've done out with employees out in the workforce, thousands of people have already responded, and we are seeing a trend where people are saying, you know what, when we do come back, when whatever this new normal is comes back online, I can see myself working at least 1 or 2 days a week. Seems to be the most interest at this stage. So it's not so much about large portions of the business all of a sudden working from home in a whole sense, but just that greater flexibility to work from home as and when needed, and feeling more confident and comfortable, but that doesn't prevent people from being included in meetings or other conversations that might be happening in the workforce. Of course, the co-workers, a very different situation. Business models built around density, around high utilisation, they are rapidly trying to evolve their business models right now. We're already seeing indicators of works happening on those sites, but the likelihood that price points may change, but that's all to be seen. But that in mind, let's have a bit of a chat about what practically needs to be done now as we're planning to come back into the workforce. So we connect every day with our global counterparts, and it's quite a mix of what governments are starting to mandate as far as what needs to be done to workplaces to make sure that they're ready for employees to come back in a very staged and considered way. So in Australia, obviously, WorkSafe has released recently some principles, some guides. They're quite high level. There's some checklists there, all very pragmatic. And I recommend it for everybody to check those out or to contact us if you can't find those. Then in other places, such as the Netherlands, they literally have a 6-foot rule. So this means that you need to measure your workplace. You need to show to the government that you're putting changes, both physical and operational. That means that 6 feet cannot, you must have 6 feet in between everyone in the office. So this actually goes beyond every second desk being commissioned. If you think about a simple corridor, it doesn't allow people to walk side by side and pass each other going in other directions. So quite a big impact. And typically we are seeing that once we do measure up workplaces, that the impact is much larger than what occupiers would be thinking at the outset. So definitely work to be done in that space. But in Australia, we're not quite expecting that level of rigidity, but it's yet to be seen. And of course, if a second wave does come, then a different scenario might come about. Now, I'm going to attempt to show my screen. Make sure we get the right one. There we go. So one of the things that we have been talking to people is just really stepping through in a very structured way how to go about thinking about planning for the changes to their current workplace. So one of the first areas that you need to consider, as well as that physical environment, is just profiling your employees and what flexibility and risk that they may have. Now, we're imagining a lot of organisations, and we've already spoken and heard that there's the Team A and Team B type of approach that they're going to be taking. And that's going to work for the majority of staff, but we are calling out that there's a number of folks that do fit in some different categories that employers need to be considerate of as part of their duty of care. There are those that are in Group A, very dependent on the office, and there's a good chance that they're already working in the office and have been for the last couple weeks. There will be infrastructure tools or personal risk factors, personal circumstances that mean that they can't work from home. Then you've got a group that strongly prefer. to be working in the office. And again, there can be a range of reasons for that. But of course, that group D is a group that either has a personal risk for their own health or are with vulnerable people, whereby coming into the office is just too great a risk for them. And we're getting a lot of feedback, particularly from Europe and in the States and large parts of Asia, where the commute is actually the biggest risk. So even though offices may open, there is a feeling from employees that getting on that train, getting on that bus is just going to be too much of a personal health risk, or for a loved one that may be vulnerable that they're living with or visiting often. So there's that to consider. Then as an organisation, you start to need to have the discussion about who would you like coming into the office in what stages. So a few different scenarios about A, B, C and D, what groups are coming in and in what formats, which there are many, many to work through. And then, of course, you partner that with that capacity assessment. So as I said, going through each of those desks, what can be used in a safe way that allows for social distancing? What risk profile is the organisation happy to take at this stage? Is it okay to walk past each other in a corridor? It's just for a split second. That might fit the risk appetite for one organisation, but for others it won't. So there's that to consider. Fundamentally, it means in the work area, you're going to have areas that are decommissioned or on hold. So some meeting rooms, some people are going to open with meeting rooms completely closed in those first couple of weeks. So because of the cleaning protocol difficulties of people coming in and out throughout the day. But there's certainly going to be those seats that can be used, and we'll put certain hygiene protocols around that. There's a risk though that if your organisation is wanting to have a bigger portion coming in and that's safe to do so, that there may actually be a gap. Your current workplace may not be able to support that. You may need to reach out and find some other ways in your portfolio, in a co-working space or otherwise, where you might need some temporary space as these restrictions evolve moving forward. So fundamentally, it comes back to creating safe environments so people trust that the environment that they're working in won't be a risk to their health or to others, and then it enables them to be productive. You're making sure you have the right size capacity, and from a risk perspective, going through all the checks and balances and measuring quite carefully that workplace to ensure that you are comfortable, that you're abiding by the 1.5 metre guidelines in Australia. And where you can recover costs, that makes sense. So there may be portions of your workplace that you can mothball, so you don't have to be thoroughly cleaning those. You don't have to be running the air conditioning in those, and some of those funds can go to the increased hygiene protocols and costs that may be associated with running the areas that are operating as we open up in the first couple of weeks. So lots to consider. And as I said, please feel free to ask some questions through the panel here or reach out to us at CBRE and we can certainly help. But I will throw you back to Adam and looks like we'll get some more questions.
Thanks, Nicole. We have had one question throughout the course of the morning, which is when should the rent reduction start? Now, it is in line with JobKeeper, which is from the 30th of March of this year. However, it may be that if you can demonstrate to your landlord that the effect has occurred prior to that, then you may be able to, as Melissa said, during the course of the negotiations, come up with a position that might be more suitable and your landlord might be more amenable to trying to resolve that issue with you. Given the time, we don't have a great deal of time for any more questions. What I would like to do is just thank each and every one of you for attending this morning, and more particularly, specifically thank each of the speakers from CBRE, RSM and our very own Melissa. Your information this morning has been truly valuable to all of us working in the industry and those who have been greatly affected by the COVID-19 pandemic. Should any of the attendees have any questions, please don't hesitate to reach out to us here at Bartier Perry and we can pass those on to the relevant speaker, or alternatively reach out to the relevant speaker in your own time. We once again thank you for tuning in this morning, and if you require any assistance, please don't hesitate to contact us. Have a great day. Bye-bye.